Good afternoon, everyone. Today is our topic, the cost of capital. And this week 9 we'll be talking about. So the questions we're going to cover today will be what is meant by the cost of capital, what is meant by the weighted average cost of capital, or what? How are the cost of each source of capital measured and combined to give the WACC? How do the issues flotation cost affect the cost of capital? What is the distinction between the company's work and the project specific cost of capital? That's our topic today. So now let's talk about what is the definition of cost of capital. Okay. So this is the cost of a firm's cost of capital is the minimum return required by the investors to compensate their providing capital to the firm. How do they mean by this? They said that, look, you are going to make an investment into the business. You are going to make an investment into the business, and the money you are going to invest, so you might be actually, it will cost you to get this, capital from the business. So what we actually are looking at here is that how much it will cost you and what is your expectations on top of it. So they say that you're making a risk, you're taking a risk in here as well. So they say minimum return required by the investor to compensate what? Providing capital to the firm. So when you are buying a share, that's an investment. When you're purchasing a share, that purchase is an investment. Okay. So now, purchasing a share means you're investing in a company. All right. So now this says here, so you need to be compensated for your investment. Now, generally speaking, investors will require a rate. How much do they need? That's a good question. How much money does the investors expect from out of the company, the investment? The investors will require a return that compensates them for the risk associated with the investment and capital market condition, including the expected future inflation. So they will be looking for an investment. They're looking for something that will cover their investment. How much does it? Let's say you took a loan from a bank and you have to pay 5% interest to the bank. On top of it, there is inflation of, let's say, another 2%. Okay. So you have to cover the company should give you expected return will be covering the 5% interest plus the inflation too. Okay. So this both needs to be covered by the company. That's what is your minimum requirement. So this says that if the rate of return of project, for example, okay, is greater than the cost of capital. If the return is greater than the cost of capital, okay, then you will be investing into this business. That's the whole point. Okay, that's the whole point. And they will do that. Net present value will be greater than 0. That means you will be investing in here too. Okay, now this says if at the given point of time, this is very confusing but very important here. If someone has asked me a question from the assignment, okay, is that what is estimated beta? Okay, estimated beta you have to actually calculate and find out estimated beta. Okay, find out the estimated beta, and yes, beta J is the estimated beta. You have to find it out by this, and I would appreciate if you guys talk rather than just texting me. When you text me, I just get distracted. I was in a flow of talking something. Okay, so when you text me like this, I get distracted. Okay, it's better if you ask me a question, quickly ask and quickly I answer. It takes a couple of seconds. If you text it, it takes time. Don't do that. Okay. You have to get out of this WhatsApp, Facebook, Messenger type of things. Okay, Snapchat and everything you guys do on texting. You have to get out of it in the classroom. Don't do that there in the class, please. If at a given point of time, the firm promised an expected return, a firm is promising an expected return, which is lower than the current required return. The firm is saying that in future, our return will be lower than the current period. What's going to happen? Investors will not be happy. There will be insufficient investors will be there, not enough investors will be there to have the, not, it doesn't say, it will not mean that everybody will leave. No, not necessarily. There will not be sufficient investors at the time. There will be insufficient investors who want to hold the firm security at the current price. Then what's going to happen? The price will fall down. Okay. Price of what? The share price will fall down. When share price falls down, equity return will come up again. There will be less people will be there, so they can distribute better. All right, let's move on. Key assumptions here. What are the cost of capital is dynamic concept and affected by variety of economic and firm specific factors. So this cost of capital depends on the business risk, financial risk mainly. So what is business risk? That's very interesting thing. Business risk is that if the firm cannot generate enough revenue to cover its operating costs, that is called business risk. It might happen that the business cannot recover its own operating costs. We'll call it business risk. And what is financial risk? Financial risk is that the business cannot recover, cannot pay its or cannot recover its financial cost, interest, leasing, these things. That is known as financial risk. Okay. Yes, and also another one is after tax costs are also relevant since the cost of capital is measured after tax basis. Now let's put on what included in a capital. How many ways you can actually raise your capital? Capital can be raised in these ways. Long-term capital, preference by long-term debt. You can go for short-term debt too, but short-term debt is very minor. It's not that big. Okay. So now this is long-term debt. Then there's a preferred, by long-term debt means you take a loan for long-term, that's long-term debt. And preference share, you issue preference share. And another one is issuing ordinary shares. Okay, 3 ways you can do those things. Okay, so now you talk about short-term debt, interest, non-interest bearing debt, like accounts payable, accrued wages, this type of. This is very minor, not that much. And they have long-term debt may take a loan for a long time, and there will be specific rate of interest to be mentioned in there. Now the question comes up: why not simply use the cost of the least cost source? So you have 3-4 sources we have seen here: short-term debt, long-term debt, preference share, ordinary share. 4 ways you can raise your capital, right? Now the question is, why we have to go for all of these 4? You can go for only one. Which one you can go for? The one has the least cost of capital. Least cost. That one we're gonna go. Here we can give us the minimum interest rate. That one we can go. Now the question is, this may not be possible all the time, because when you take, like if you go for like a short-term one, for example, short-term has no interest bearing. You see, non-interest, there is no interest in there. But is it enough? It's not. That's the problem. Problem is the amount. Okay. So if you want to go for a bigger project, bigger amount, you need to pay cost of capital. A lot of money comes in there. All right. Now the question comes up. In this circumstances, simply comparing the expected returns on an investment proposal to the cost of current cost of. Let's move on this one now. Let's go in here. So now it happens that it's not necessarily all the time that we can go for only one source. We go for various sources. Maybe we go for let's say 100,000 from long-term debt, 200,000 from preference share, 300,000 from ordinary share, then let's say 50,000 from the short-term debt. You can get money from various sources together as well. Not necessarily we'll have to go only one source. Not enough, maybe. Okay, so that's what we'll go for. Multi sources we'll go for. All right. When you go for multi sources, then what happens? Then if you go multi sources, then how do we actually measure our cost of capital? Some of them will be 10%, some of them will be 8%, some of them will be 12%, some of them will be 5%. So different percentage will be involved here. So how do we measure that time? There's a time what comes up. Weighted average cost of capital comes up. Okay. How do you do the weighted average cost of capital? We actually use this formula for weighted average cost of capital. Okay, use this formula. Okay. What is this formula about? This formula actually tells you about weight and rate, weights and rates, weights and rates. Weight one, rate one, weight two, rate two, weight three, rate two. What is this weight? Rate we understand, like for example, let's say you took 100,000. Okay, weight means here the percentage. Okay, what is the weight? Out of, let's say you took $1 million of loan. Okay, from one source you took 500,000. Another source you took, let's say 300,000. Another source you took 200,000. All three together, you got 1 million. Okay, so the one you took 500,000, the rate is let's say 6%. The one you took 300,000, that rate is let's say 8%. The one you took 200,000, let's say the rate is actually the 9%. Okay. How do you combine them and come to a conclusion? How much is the rate of interest? Okay, that's what it is we will be talking about today. All right, so there are some assumptions involved. This is a basic formula here. The basic formula for the work is this one. Okay, so let me just choose. This is RA. That's how we actually represent RA is the cost of capital. And assumptions. The first assumption is that the basic assumptions. First one is undertaking of an investment project will not change the business risk associated with the firm's asset. Firm share. Okay, so the risk you already have, it has nothing to do. Okay, the undertaking of an investment project will not change the business risk. What is business risk? Business risk means when you cannot recover operating cost. That's called business risk. Okay. Or the mention business is the risk to the firm being unable to cover the operating cost. That's business risk. Another one is that the undertaking of investment project will not change the financial risk either. Okay, the undertaking of investment project, let's say you took an investment project and it's not going to change the financial risk the shareholders are facing. What is financial risk? The risk of the firm of being unable to cover the required financial obligation, interest, lease payment, this type of things. Okay. Now, so here is our RI is the, so it's mentioning in here like RI, WI, RI, WP, RP, WS, RS. Okay. So it's the mention here like these things. Okay. This is the proportion which I said about percentage. The proportion. So RI is the after company tax cost of long-term debt. RP is the cost of preferred share capital. RI is the cost of ordinary share capital. So this says here three different ways they treat the money. One is taken by I, interest rate they're paying. P, preferred share. S, ordinary shares they're paying. Okay, three different sources they use in India. All right, now so how do you measure the weights? I already mentioned you that how they're going to measure it proportionally. They said the weights can be estimated on a book value or current market value basis. The market value weights being preferred. Market value. Okay. We'll talk about this, like what are the how proportionally you're going to do. I want to go and solve one problem first. Now here is some data. This says WI is 0.07. It means I can see here interest rate is 7%. Then RP is 0.075, R and 12%. So 3R is provided in here. Okay, 3R is provided in here. 3W is provided here. What will be RP? Okay, so ROIW, so 0.07 multiplied by 0.30. Yes, see, that's how you get it, like 10.05%. That's how you calculate weighted average cost of capital. Okay. All right, the cost of long-term debt. Now we're talking about different types of debts. How do you calculate these things? Okay. Now, to be consistent with the text, we will simplify matter by assuming new long-term debt financing is okay. The issuance of new bond normally involves flotation cost. We'll talk about it. Representing underwriting and administrative cost, which reduces the net profit. Okay. Let's solve one of these problems. Okay. We proceeded by the firstly calculating the before tax cost of debt. What does it mean, the before tax cost of debt? That's very interesting here. You know what? When you take a loan, you have to pay interest. Interest is an expense. This expense will be supported by your tax. 30% tax rate in Australia we have. Let's say that you took a loan. Okay, you took a loan. So loan rate is, let's say, for example, 8%. Okay, you have 8% of loan, for example. Okay, 8% interest on the loan. Now the problem will be that you do not, you will say, okay, 8% of, let's say, $100,000 is gonna be, let's say, 80,000. Sorry, $8,000. Okay, but when the $8,000 you pay the interest, right? But this $8,000 will save you some money too. 2,400 will be saved. How? 30% tax will be deducted. Okay, so when you pay the tax, that time you mentioned that my business had $8,000 of interest expense. So this $8,000 will be subtracted from your income. Okay, so that's why this says here that it happens that you will be saving some money from the tax too. So that's how they find out RI will be RD into 1 minus T. Okay, what does it mean here? As a simple example, suppose a firm faces a tax rate of 30% and pays $100 interest on its $1,000 debt, representing an interest charge before the tax of debt of 10%. So 10% is an interest you have to pay. So $1,000 you took a loan and 10% interest, which is actually $100 interest you paid. By claiming the $100 interest as a deduction from its taxable earnings, the firm's tax liability is reduced by $30. So 30% tax you don't have to pay now. Thus, the net after-tax interest repayment associated with the debt is 100 minus 30, 70%. So it's actually your 7% interest you pay. Okay, that's how they want to say here. How do we do these things? We do this thing by using this formula. Okay, RD into 1 minus T. So we get the debt rate, how much is debt rate? 10%. So it's a 10% into 1 minus 3. T is tax rate. Okay, there are essentially two methods of obtaining the before tax cost of issuing. So now this is one thing. Using the current yield of maturity on similar risk bond, this would allow us to work out what price a new issue would be sold at, hence the new proceeds after subtracting the flotation cost. Now the thing is that what are the formulas we're going to use to find out how much should be our before tax cost. This is net processing. This is the formula we have here. Okay, this is the formula we're going to apply here. And now you might ask me questions here. Finding the interest rate that equates the net proceeds of issuing bond with the present value of the future cash flows going to be holder of the bond. So this is the this is the formula actually. How do you calculate the RD? Method involves finding RD in the following equation. So they mean here that how would you know finding the interest rate? At what interest rate that will equal the net proceed of issuing the bond is the present value of the future cash flow is going to be a holder of the bond. So how much money you are getting in future? Okay, the present value of all those money today and the issue cost. Okay, how much you are getting, like the net proceedings of issuing the bond. How much money you getting today? So at what interest rate it will become zero? That's how they mean the issuing rate. So that this says here the net proceeds should be equal to is better now. So net proceeds should be equal to I I is annual interest payment, how much interest you pay. It is multiplied by 1 divided by RD. This RD we are going to actually calculate from here. What will be the RD rate? Okay. So they try to say here that what money you are getting in future. Okay. They said here the final interest rate that equates the net proceeds of issuing the bond with the present value of the future cash flows going to be holded to the bond. So how much money you are going to pay to the bond that you are issuing a bond. So how much money you have to pay them, and how much money you actually generating from them. At what rate you have to pay, so that your present value of outgoing and your present value of today, how much money you're gaining from them will be equal. That is called RD. That's RD they are going to calculate from here. All right. Note, if we calculate RIRD with the RD as above, strictly speaking, we are acting as if the repayment of par value is also tax deductible. It is possible to avoid this error by working on that. Let's just telling you that what the equation we should apply. Let's solve one problem in here, then you can understand it better. Better now. So they have an example in here. Let's do one example. It will make it better. So UWS Incorporated is currently able to issue 20-year maturity bond each with a face value of $100,000. The coupon rate is 6% per annum. The interest would be paid annually. Because of market conditions, the bond can only be sold $96,000. Production cost of 2% per value, and the company faces 30% taxes. What is the current after tax of other cost bonds? Let's see. So now we from the formula we can see that we need I. This is the formula. This formula. Yeah. This is our formula. We need to calculate this I first. Okay. What is I? I is the interest payment. How much is the interest payment? Annual interest payment is here 6%, $100,000. Yeah. That is for the bond coupon rate you're paying. So you're paying $6,000 every year. Okay, you're paying $6,000. All right. For how long you're paying? This 20 years maturity bond. So it will be annually 20. Okay. 1 divided by 1 plus RD. Okay. At what rate you are paying? We're going to calculate these things. Okay. So here is our formula in here. So they actually calculated these things. And you have to use a scientific calculator to find these things. Calculation of RD using scientific calculator method of interpretation, exploration maybe in the final exam. Okay. So the two in here actually. All right. We need to find out RD where V0 equal to 96,000. Let's do it from here. So we have to actually find out RD. V0 96,000. Please note that RD is 6%, V0 is 100,000. How do they mean by these things actually? Let's have a look at the questions here. Here's the face value. Try to understand the problem first before we go ahead. Okay. So they're trying to say you here that the company is issuing a bond. At how much price they're issuing? They're issuing at $96,000. Okay. They're issuing at $96,000. And this company will be paying $6,000 every year to the bond holder. For how long? For next 20 years. This money will be going out from the business. Fine. And we are going to find out at what rate, what would be the rate would actually equalize. How much money did you raise from them? That is net proceeds. Okay. So we are getting only, look at here, $94,000. Okay. Net proceeds from the sale of one bond, $96,000 they will get, minus 0.02 is production cost into 100,000. Okay. Now, so when you issue the bond, you have some other expenses involved in here too. Okay. Some other related in the cost in there we have too. So when you issue the bond, you'll get $96,000. Minus there are some other costs involved to issue that bond. So end of the day, you will get $96,000. That's the net proceeds. And every year you are paying them $6,000 for next 20 years. Okay. Now you need to find out at what rate we should pay them. Okay. At what will be the rate that will be also the value of all this money will be also 94,000. That's what is our target to calculate. Okay. All right. So we need to find out RD on V0 is 96,000. RD is 6%, $100,000. Okay. To get V0 94,000, RD must be greater than 0.06. So again, there we are doing here like the last time we did like IRR. How do we calculate that? Trial and error basis. So to get V0 94, okay. Firstly, we consider RD 0.7. So now, as I said, it's trial and error. We take checking 6%, 7%. Then we see what the proportion it comes up like. Same as we did last week, like IRR, how we calculate IRR. Same thing. So at 6%, what it is, we found out that 6% it will be 894, 89,405 this much, which is less than 94. Okay. Now we try with, now it is clear that 6% is okay. I change RD to 7%. Okay, 7 to 0.05. And V0 will become this much. So this minus this much. So we're trying to find out how much is left, 5085. So again, we're going to do, see that the proportion we're going to find. So how much is left out? So this is just actually a unit format of doing these things, nothing else. So here we found that it is the value is 89,405, but our target is to make it 94, so which is less than this. So how much more we have to achieve? We will have to actually achieve here another 490. Okay. Not 490, 94, yeah, 5085. That's what that much we have, that much more we need now. Okay, that much else also we have to recover. Okay. Our goal is to find the value of RD when V0 equal to 90. But we found only how much? 89. Okay. So try with 0.65. With 0.65, we found this much, 94,000. So it definitely it will be in between 6.5% and 7% between these two. Okay. So if we use it as 7%, it becomes 894. Let's reduce it. Go to 6.5. 6.5. If you go to 6.5, and we see we reduce too much, it becomes like this much. 6.5. It will be 94. This much it will be. So how much gap we have? 5085 is our gap. Okay. Our goal is to find the value RD and do 94. So when we go for 6.5%, okay, then we get 94, 490 less. Then AB is equal to 50. This must, if you go for B0, 5085 is equal to 0.05%. So two volume we got in here. So 0.5% of increases, this much value increases. So we have to increase only 490 decrease, how much it will be. So this is just an unitary problem in here. Now this thing can be calculated by, you don't have to go through all these things, we use a scientific calculator. All right, and you can do also the same thing by using Excel as well. Using Excel, you can do the same thing. In Excel, you have to go for rate 26,000 minus 94 minus 1,000. Press enter, it will give you the data 6.55. Okay. Our cost of preference shares, how do we calculate this one? Now, the test considers the, okay, that we're talking about, calculating the cost of existing preference share. What is preference share? Preference share is a share, and when you use a preference share, that means you are making a promise to the preference shareholder that they will be paid a specific percentage of interest, dividend. A specific percentage dividend will be paid to them. That's what you're making a promise to that preference shareholders. Okay. And the ordinary shareholders will not make any promise. The board of directors will decide how much to be paid. That much you will be paying them. Okay, board of directors will be deciding on annual general meeting that this year we are going to pay 5% dividend to our shareholders or something. Okay, that is ordinary shareholders. All right. Okay. So they have formula in here. So what formula you're trying to do here? So preference share dividends are normally expressed as a percentage of the par value of the share. Okay. So let's say you buy $10 share, and they will be giving you 5%. 5% of $10 they will be giving you. That's how they will be here. Okay, 5% of not the profit, 5% of your investment. All right. DP is annual cash preference share. DP is equal to annual cash preference share dividend in dollars. D for dividend and P referring to preference share. P is the price of current market price. RP, current cost of existing preference share. Okay, so from the present value of perpetuity formula, we know that price equal to P equal to DP by RP, and then we reorganize them. We get RP equal to DP by price. So it means how much dividend you are receiving, or how much was the price of the share. That tells you about the rate of preference share investment. So here is an example. This is the example they have here. $10 or $20 is the price of the share, and they receive 192 as their dividend. What is the rate? So 0.96 is 9.6% rate. Okay, so another example is given to example. Now, what they say is, now suppose UWS Incorporated. Okay, now suppose UWS Incorporated can sell new preference shares with a par value of $24 for 20 each. Okay, and the shares will pay 8% dividend. Now they're going to their existing share was $20, but they're going to, and the old share was $20. Now they're going to issue a new share, which will be $24. The shares will pay 8% dividend. Calculate the cost of these new preference shares if flotation cost is 20 cents per share issued. Again, now we find out the net proceeds, how much you're getting. So even if we are actually getting $20, can sell new preference shares with a par value of 24. So, oh, okay, sorry, they're selling $24 share at $20. They're selling at a lower price. So it's not like increasing the share, it's actually lowering the share. Okay, so $24 share, they're selling for $20. The flotation cost is 20% per share issued. Okay, all right. Sorry, 20 cents per share issued. So $20 is that. So when you sell a new share, you'll receive $20, but every share has a 20 cents of costing. 1%. Okay, 19.80. As in the previous example, the preferred dividend is 1.92. So yes, so now how much it will be? RP will be 9.697. All right. So their share price, share value was 24. $24. The cost of acquisition, now we're talking about ordinary share. So three things you're talking about here. One is interest rate, one is preference share, one is ordinary share. Okay. Ordinary shares, discounted cash flow approach, we'll say that in ordinary shares. How much dividend you are getting? So ordinary shares, like you don't know how much money you'll get. Ordinary shares, they don't mention how much. There is no guarantee of money. But when they will, every year they will declare how much they will be giving you. Annual general meetings for that. So price of the share will be equal to the discounted cash flow, discounted future cash flows will be described in here. Okay. All right. So this is actually expected dividend, expected cash dividend per share in period two. Here there is no percentage will be mentioned earlier. It's another example we have in here. Okay, this says here that suppose UWS Incorporated ordinary shares are currently selling at $10 each. $10 is each share. The last dividend paid was $1 per share, and constant dividend growth is 2%. And every year they increasing 2%. Okay. All right. So 1.02 per annum is expected in the future. Using this information, calculate the current cost of these ordinary shares. So we use this formula. So dividend 1 will be equal to dividend 0 into dividend 1 means this year dividend will be previous year dividend plus the growth. So previous 1 plus G growth. 1.02. So that's how we calculate here. That that RS will be D1 by P0 plus growth. The dividend 1.02. Price 0, $10 plus G is 2% growth rate, which will be 0.1, which is 4.2%. All right, and then is CAPM method. That's you guys already working on CAPM. You guys know it better. Okay, so RF, risk-free return, plus B is your beta, market return minus risk-free return, which will tell you about the return for the share. The RS, return for the share. So another one is the same here. Example, use the CAPM approach to estimate UWS Incorporated's cost of ordinary share. If risk-free rate is 6%, market rate is 10%, or RM, or and beta is 1.15. How much will be your return for that share? Plug and play. Okay. Cost of retained earnings. Retained earnings is another source of capital. Retained earnings means that when you make a profit of the business makes a profit, they do not spend out all the profit. They keep some profit for a better use of the business next time. That is called retained earnings. Okay. Retained earnings represent an increase in the ordinary equity financing the business. The cost of retained earnings is taken as being equal to the cost of existing ordinary shareholders. Okay. Nothing much actually. The cost of new ordinary shares. Okay, another example is in here. The same formula they apply here. The same. Suppose that the expected proceeds from a new issue of UWS Incorporated ordinary share is 9.50. So if they issue a share, they will receive $9.50. Again, assume the last dividend paid was $1 per share, and constant dividend growth is 2% as usual. Per annum is expected in the future. Using this formulation information, that were the cost of new issue of ordinary shares. So all right. So this says here, dividend 1 is equal to dividend 0, same way, to calculate the dividend 1, current year dividend based on the previous year. The 2% growth is there. RN will be how much? Same thing. Okay, dividend divided by NN, that is what is the ordinary share price. Z is your growth rate, 2%. Okay, another work example they gave here. It refers to the previous example in the section. Suppose UWS Incorporated is to raise new capital. Okay. Using the mixture of new bond. Now they're going mixture. They're issuing bond, mixture of a new bond issues, preference share issues, and retained earnings. With the following weights being calculated. Okay. So WI, this will be your WI is your this is share, this payment, this is bond. WI is your bond, P is your preference share, WP preference share, and WS is ordinary shares. And look, all these three will be proportionately, it will be 1. Okay, 100%. 40%, 10%, 50%, plus 50%, 100%. Calculate the work of this situation. So, very easy. So you know now this WI, WP, WS, you know this three. Now I need R1, RI, RP, RS. That's also given here. Plug and play. Nothing much. All right. Now we have to go through this problem. Now you're going to solve this. How many questions we have here today? 2, 3, 4 questions. All right. Let's solve this 4 questions. Okay. So this is the first question is about Nostland Plumbing Company is considering expanding its operations by purchasing a truck, especially outfitted for work involving the unblocking of drains. The truck can be purchased at $140,000 fully equipped and would have a useful working life for 10 years. There would be no installation cost. The purchase price would be depreciated fully over the truck's working life using prime cost, step-like depreciation method. Okay. All right. And the truck would have an expected salvage value of $20,000 after 10 years. The company pays a tax rate of 30% if the new truck are put in operation. An increase in net working capital $8,000 would be required. Purchase and operation of the truck would increase the company's annual profit before depreciation and taxes by $28,000 over the useful life of the truck. For the project involving purchase and operations, okay. So the project involving the purchase and operation of truck, calculate the initial investment, annual operating cash inflows, and terminal cash flows for operating budget purpose. Now let's do this one by one. Okay, how much would be initial investment? Equal to 14,000. Okay. 14,000 plus 8,000. Not 40, 140. Plus 2. Depreciation, how much will be depreciation? Depreciation depreciation will be how much? 140 divided by 10. Annual net profit before tax. Net profit before tax. Annual operating cash flows. Will be okay. How much? 0.7. Annual operating cash flows. Yes. Okay. 20,000. Okay, now the question is here. You understand the depreciation and all this. You understand this now. The annual net profit before the tax. Okay. So look, these will be. Why did we add back this minus 14,000 is in here? Because they're part of depreciation. Okay. So in that we do not actually calculate depreciation as our depreciation expense. So this is not a part of your tax. Okay. All right. So after tax, we're gonna actually look at yes 0.7. Why 0.7? 0.7 is actually, I'll show you here better way. You can say like 1 minus tax. Tax is 30% is your tax. So if you subtract you because you are not paying that 30% on this 14,000 of depreciation. So that's how you'll be saving that like 30%. So how much you'll be paying? You pay 70% you'll be paying on. How much tax you'll be paying? You'll be paying only 70% tax you'll be paying, not 70% tax you're gonna pay because 30% will be off. 0.7. 30% will be saved. Of this $14,000. 30% tax you're not gonna pay. Annual operating cash flows is 9,800. The tax, how much is profit plus the depreciation. Terminal one, like the pay that the value you will get, you see the salvage value of 20,000 for 10 years. Terminal value is at the end of the day how much you are receiving. Okay, now suppose the appropriate cost of capital for the project involving purchase and operation of the truck is 9% per annum. Calculate the net present value of the project. State whether the project is acceptable or not by the net present value criteria. Here we have to apply the net present value formula. All right, here we're going to apply the equation. Here it's net present value will be equal to your $22,800, okay, which is your annual operating cash inflow, okay, and then we can add 1 minus 1.09% per annum, 1.09% per annum. It will be divided by 0.09. Divided by so this will be your total net present total incoming, okay, minus the outgoing will be 148. That will be equal to of 13,000. That's it. Acceptable or not? Of course, acceptable because we think that it's positive, so it is acceptable. Okay. Number 3. Number 7, number 3. Assuming the project of purchasing and operating the truck is ongoing in the sense that the truck would be replaced by the similar truck at the end of working life. Determine the annual net present value A and PB. Okay. Now, we go in here. Equal to EG multiplied by R, okay, divided by 1 minus first bracket 1 plus R. Okay, let's give me a second. Let's charge mine. One plus R to the power minus. Okay, so we do the same thing. The net present value is 14,033.29 multiplied by R is 0.09 divided by 1 plus R will be there. So 0.09 to the power n will be minus 10. The answer will be here 2,186. The next question. Murdoch Banks is in the process of evaluating two mutually exclusive additions to their processing capacity. The firm's financial analysts have developed pessimistic, most likely and optimistic estimates, sensitivity analysis, okay, of the annual net cash inflow associated with each project. These estimates are given in the following table. So they give an initial investment, all this they're giving you here. Determine the range of annual net cash inflows for each of the two projects, assume the firm's cost of capital. Let's go ahead, do this things. Determine the range of annual net cash flows. So how much will be the range for project A? Range for A. Range for A will be how much? Here is maximum is 1800, minimum is 200. So I think you know the following statistics. 1800 minus 200, 1600. For B will be maximum is 11, 9, 200. Okay. So it will be 1800. 200, 600, and then for B. All right, fellas. Then what next? Assuming that the firm's cost of capital is 10% and the both projects have 20 years life, construct a table similar to the above. Net present value is including the range of the net present value is all right. So we have to calculate the net present value of instance. How do we calculate it? Net present value. For project A and for project B. Okay. You know how to calculate net present values now, right? It will be, so I'll show you only one. Okay. So here is net present value. Net present value is equal to this one. First one you can see here 200. The person is going to do okay 200. And here is bottom that. Yes. Equal to 6,200. That's what we are using, right? And it is pessimistic. Okay. -7. For most likely, it will be 5, 1, 2, 6, 7,000. For project B, minus 7, 179. Stickers. And here will be the launch. Then you know that highest minus lowest. The highest is 70, minus lowest is -2. So this will become added up. Okay, the range is 0,000, 1,000, 600, 70. For project B, it will be 1,700. Do part A and B provide consistent view of the two projects? Explain why. So look, the initial investment for the both the project is actually the same. Okay. The range of cash flows you can see here is are also consistent in here, to be honest. Like range of cash flows, the cash flows they have. So this is like when they come in the negative 513, 513. It's actually consistent in both the cases. Which project would you recommend and why? Okay. Look, in this case, A is very risky because if it goes bad, it goes really, really bad. It makes a good profit, that's true. But most likely they're gonna make 513. Here also makes 513. But the problem is pessimistic one. They are, when they go bad, they go really bad. That's the problem. Your friend is seeking your advice because he believes you have studied finance so much good at and making financial decisions. He is considering investing in a small business that has the following features. The business costs $20,000. It will generate a net cash inflow of $1,500 in 1 year's time. Okay. In 1 year, and since the inception of the project, but the cash flow will grow thereafter 1.5% per annum for an indefinite period of time. Your friend requires a return of 8% per annum from the investment using NPV method. Recommend whether your friend invest in business because it's resident is these are this. Which one you should go for? Okay. All right. So let's do these things. How are we going to do this one? So this is actually what the case you can see here is growing perpetuity is the yeah. Okay. This is the case of growing perpetuity and present value of the, let's calculate the present value of the business. Okay. Present value of the business will be equal to payment divided by QE, which is the here is the recovery rate of return. The rate of return minus the growth equal to how much is the payment? So here the payment is $1,500. Okay. The rate of return 8%. 8. And this growth is actually 1.5%. 5. Okay. Answer here is equal to 23,076. Okay. So his initial payment is how much? $20,000, but the value of the business is 23,000 this much. Okay, it means that you should go for the business. All right. Number 4. Okay. Country Wallpaper is considering investment in one of the 3 mutually exclusive projects, E, F, and G. The firm's cost of capital is 15% and the risk-free rate RF is 10%. The farmers gathered the following basic cash flow and risk index data for each project. E, F, and G. Initial invest 15,000, 11,000, 19,000. Net cash inflows are already provided. Risk index REI is provided. It's listed risk. This is the risky business 1.8. We find the net present value of each project using the farm's cost of capital. Which project is preferred in this situation? Okay. All right. The net present value for E, F, and G, three of them we have to find out. We're gonna do these things. Mhm. 6,000. This is the E. $6,000 by this plus we have to do the same thing for 4 years. Okay. This year, so 6,450. All right. Okay. Answer here will be 1,000. So here is so which one should be selected? Which column is to be selected? This one gets the maximum net present value. Go for net present value E. Okay. So this will, when we see all of them paying the same amount, okay, you use the perpetuity. Okay. Let's see. We go for project E. That gives the maximum 2,100. All right. Number B. The firm uses the following equation to determine the risk-adjusted discount. Okay. And RDA, okay, discount rate rather for the project D, these ones. Substitute each project is indexed into the equation to determine the RADR. Okay, so we have to calculate with the RADR. This is our formula. All right, good. We can use this one formula. RADR equal to RF plus RIJ, which is going to say RIE for project E, okay, into R into RF risk rebate. We use this formula. We change this one. Formula. RDE, E, okay. RF plus RI must G just E, okay. E, the R minus RF. This is the formula we have to do. Would be equal to RF is 10%, so 10 plus which we call we could 1 plus 1 times answer here is yeah. So RE, okay, we do exactly the same thing. So, RF. So all remains same. It's just this one. This will become 8, 1, 6. Six. Okay. This is the situation. Okay. So this risk rate remain the same, 10% for all of them. And this is your beta figure. Okay, this is the beta figure RI, which is risk index. One is 1.81 and 6. Okay. 1.81 and 0.6. Okay. That's what we have applied. Other things remain the same. Like 15% is the market premium. All right. Now the next question is about use the radar for use project to determine the risk adjusted net present value, which project preferable in this situation. Now we have to calculate the risk adjusted present value. Okay. All right. So we'll do it now. Now we have to use this interest rate. Okay, that's all, nothing else. It is exactly this interest rate, nothing else. We'll do exactly the same thing from here, but interest rate will be changed, nothing else. Okay, so interest rate is not 0.15 anymore, it will be 0.19. Okay. That's it. Nothing else gonna change. Everything remains the same as this. Okay, the answer will be here. 831. 5. So let me look at this one. All right, next is F. Everything remains same, and so then 15%. Or 15 remains the same as it is, no change. Okay, and the last one is 13%, not 15 here. Answer here will be all right. The discussion here we have to make the last point. Compare the discussions, finding part A and C. So we just have showed you here A and C. So the net present value for E, the risk is too high and the return is low. See, first one risk is 1.8, and I said it's very high risk. And you can see here net present value of project E will be 8.31. But this one is net risk is very low, 60%, 0.6. But the second one risk remains the same, no changes. It also payment remains also the same. Net payment also remains the same. Okay, that's it. All right, I'll stop it in here for our recording. So stop it.